Hello everyone, welcome to JIB CIB Prep. In today's video, we'll discuss about non-performing assets or stressed assets. So we'll cover unit number 28. In this particular unit, we'll understand what is a non-performing asset, we'll understand about income recognition policy, how do we compute gross advances, non-performing assets, what is an asset classification. So we classify assets into substandard assets, doubtful assets, loss assets. We'll learn about provisioning norms, how to write off loans, what are the prudential norms applicable to restructuring. So we'll understand about some other aspects. We'll wind up this class by doing our practice questions. So let's begin. Lending is the main business of banks, but it comes with a big challenge. Not all loans are repaid on time. And to make sure banks present their account fairly and maintain financial discipline, Reserve Bank of India introduced prudential norms for income recognition and asset classification. Now, these norms are in line with global practices and were recommended by Narsimham Committee. They deal with three aspects. Number one, income recognition, how banks should record income from loan. Number two is asset classification, how loans should be categorized depending on whether borrowers are paying on time. Number third is provisioning, how much money banks should set aside to cover possible losses from bad loans. Now let's understand what is a non-performing asset. So simply stating, an asset becomes non-performing asset when it stops generating income for the bank. Now what is an asset? Asset in banking context means loan, advances, and a leased asset. So for bank, when bank lend to someone, bank earn interest. So a loan is an asset for bank. And when it stops generating income for the bank, this means that the borrower has not paid interest or principal for a specified period. And a loan is treated as a non-performing asset if it is a term loan and overdue is for 90 days or more. If it is a cash credit or overdraft, if the account is treated as out of order, if it's a bill purchased or discounted, uh, and the bill remains unpaid for more than 90 days, if it's a crop loan, if it is a short crop loan, so if dues remain unpaid for two crop seasons, and if it is a long duration crop, if dues remain unpaid for one crop season, and if it is a securitization transaction, if the liquidity facility remains unpaid for more than 90 days, and in derivative transaction also, if receivables remain unpaid for more than 90 days after the due date. So simply stating, a loan does not bring income to the bank for 90 days or more, it becomes non-performing assets. So this is the criteria for classifying whether an asset has become a non-performing asset or not. So when we say overdue, overdue means any payment due to the bank that is not paid on scheduled date. For example, the bank is expecting the payment on 10th of August, but the payment was not made on that date. The date was the scheduled date. On scheduled date, the loan becomes overdue and it is not paid on that time. So it becomes overdue. So the payment has to be made on the scheduled date. It does not happen on that date. So simply stating, it becomes overdue. And what is an out of order? So an overdraft or cash credit account is considered out of order when the outstanding balance is above the sanction limit or drawing power for 90 days continuously, and the balance is, if the balance is within the limits, but there are no deposit or credits made for 90 days, and if the balance is within the limit but the deposits made are not enough to cover interest charge for 90 days, so the status becomes out of order. This means that even if the account is not overdrawn, if the customer is not actively maintaining it or paying interest, the account is still treated as a non-performing asset. So I hope it is clear what is a non-performing asset, what is out of order, and what is overdue. Now let's understand about income recognition. So banks must follow objective rules for recognizing income and they cannot rely on subjective judgments. The key principle is no income from NPA. No income from NPA. Meaning to say, bank must not record interest from NPAs unless actually it is received in cash. Even if government guarantees the loan, interest cannot be booked unless it is realized. So income to be recognized only on actual receipts from NPA. If income is from secured advances for loans backed by deposits, insurance policies, etc., so interest may be booked on the due date provided the margin is sufficient. For fees and commission, if a loan is rescheduled or renegotiated, fees earned must be recognized gradually over the extended period of time. For reversal of income, so when a performing loan turns into an NPA, the bank must reverse income already recorded but not actually received. This ensures that the bank's profits are not inflated, and this applies to interest on loans, fees and commissions accrued, and financial charges on the leased assets. Recovery appropriation. So when a borrower makes a payment towards a non-performing asset, bank must decide whether to adjust it against interest due or principal due. If there is no clear agreement with the borrower, bank must follow uniform policy across all accounts. Importantly, bank cannot show interest as income if it is repaid using fresh loan from the bank itself. Interest application. So once an account becomes a non-performing asset, the bank must reverse unpaid interest already charged to the borrower. No fresh interest should be applied. However, banks can keep track of such interest in memorandum account just for record keeping and not for profit calculation. For calculating total advances, such interest is not included. And reporting, so every year bank must report their NPAs on 31st March after audit, and this includes both domestic and foreign NPAs. So foreign NPAs is loans at overseas branches, and they must report figures like gross advances, gross NPAs, net NPAs, and this comes to the question how they are computed. So now let's understand how they are computed. So what is a gross advance? Gross advance means total loan given by bank. So this is total loan given by bank. Hence, it includes both standard assets, loans which are being repaid properly, and gross NPAs loan where repayment has stopped or is overdue. So, gross advances includes standard assets plus gross NPAs. Now, gross NPAs, so these are the loans where the borrower has stopped repaying for 90 days or more, and it includes principal amount due and interest amount also. Gross NPA percentage is calculated by dividing gross NPA by gross advances and multiplying it by 100. Net advances are calculated by taking gross advances and then subtracting all the deductions. So deductions include the provisions, um, guarantee, which insurance covers on deposits, part payment received but which is kept in suspense account, sundry account deposits, floating provisions. So these all are included under deductions. So net advances are calculated by taking gross advances and then subtracting certain deductions. Net non-performing assets. So gross non-performing assets minus deduction equals to net non-performing assets. And as percentage, it is net NPA divided by net advances into 100. Now, there are certain clarifications that gross figures shows the overall loan book. Net figures show the real risk after provisions, and regulators, auditors, and investors use this number to judge how healthy a bank is. Just a moment. Okay. Asset classification. So there are three categories in which NPAs are classified. So not all NPAs are the same. Bank divide them into three categories. Number first is substandard assets. These are loans that have been NPAs for up to 12 months. Now they have weakness and there is a chance that the bank may suffer loss if issues are not fixed. Then there are doubtful assets. See, these are the loans which remain substandard for more than 12 months. So it becomes doubtful. These loans have all the weaknesses of substandard assets, but with a much higher risk. Recovery of full amount is highly doubtful. And then there are loss assets. These are loans identified by the bank, auditor, or RBI as irrecoverable. Even though small recovery may be possible, they are essentially worthless as assets. So ideally, they should be written off. Loss assets are written off. Guidelines for classification of assets. So bank need to classify assets correctly and consistently. Some of the important rules are number one, temporary issues, accounts with temporary issues. So a loan should not be called NPA just because of small short-term issues such as late submission of stock statement, temporary excess drawing above limit, if there is any delay in renewing loan limits. So in these cases, a loan should not be called as non-performing assets. However, if stock statement remains older than 3 months, it becomes irregular account. And if irregular drawings continue for 90 days, account becomes non-performing asset. If loan limits are not renewed within 180 days, it also becomes non-performing asset. And the borrower pays back overdue principal and interest, the account can be upgraded back to standard. So the NPA can be upgraded to standard if areas are cleared. Number two, account regularized near balance sheet date. So if a borrower deposit money just before March 31st to make the account look good, bank must be careful. If the account still shows weakness, it should remain non-performing asset. The facility, the classification should be borrower wise and not facility wise. So if one loan of the borrower becomes non-performing asset, all loans given to that borrower must be treated as a non-performing asset. For example, if a borrower has a home loan and a business loan, and one of the loan become non-performing asset, then the other must also be classified as non-performing asset, and it should not be facility based. We should not see it from one loan. From one loan, we should see the overall loans. And derivatives contract also, if the overdue receivables from derivatives, so the positive M2M value is not paid for 90 days, then also it becomes a non-performing asset. Consortium advances, so sometimes a borrower takes big loans uh, that is too large for one bank to handle. In such cases, several banks come together and give the loan jointly, and this is called consortium loan. Each bank has its share in the loan and in the recovery. For asset classification, every bank will look at the repayment received for its own share. And to avoid confusion, the participating banks must get their share of recovery transferred from the lead bank. Now, what is a lead bank? The main bank managing the consortium. Lead bank, the bank managing the consortium, or get written consent for such transfer. This ensures each bank record the account correctly in their own books. Accounts where security values erode due to fraud. So sometimes the borrower commits fraud or the value of security collapses so much that the recovery becomes doubtful. In such a cases, banks should not wait for the loan to pass through the usual stage, which is substandard. What is the usual stage? Substandard, doubtful, and loss. So this is the usual stage. The bank should not actually wait for these stages. Instead, the account should be straight away classified as doubtful or loss asset. Advance to PACS or FSS under on lending system. So what is PACS? It is primary agriculture credit societies, and FSS is farmer service societies. So PACS and FSS borrows from commercial banks and further on lend to farmers. Now, if PACS default in one crop season or two crop seasons, where one crop season with respect to long-term loan and two crop season with respect to short-term loan, only that specific facility becomes non-performing asset. Other loans given to primary agriculture credit societies or farmer service societies, they remain unaffected. However, if the bank directly gives a loan to an individual farmer who is also a member of PACS and one of his loans become NPA, then all his direct loans are treated as NPA. Why? Because we are classifying the loans borrower wise and not facility wise. Advances against fully secured assets like term deposits, NSCs. So if a loan is given against safe securities like term deposit, national savings certificate, Kisan Vikas Patrika, Indra Vikas Patra. So these loans are not treated as non-performing assets because the bank already holds fully secure assets. But this rule does not apply to loans against gold, government securities, or other marketable securities. Keep that in mind. Loans with moratorium. So, industrial and agriculture project loans often have a moratorium period. What is a moratorium period? It is time during which repayment is not expected. So, interest becomes due only after the moratorium ends, and only if interest is unpaid after the due date, NPA classification starts. And for staff housing loans, where interest is payable after principal repayment, where interest is not overdue from the first quarter, they becomes NPA only when there is a default in paying principal installments or interest after it becomes due. Agriculture advances. So for short duration crops, loan become NPA if it is overdue for two crop season, for long duration for one crop season. Now, who decides crop duration? It is decided by state level bankers committee. So state level bankers committee decided the crop duration, and if there is a national calamity, if flood, drought or other calamities affect repayment, banks may convert short term loans into term loans. They can reschedule repayment or give fresh short term loans. Now these restructured loans are treated as current dues and not NPAs. Similarly, rural housing loans under government schemes, so like Indra Awas Yojana, Golden Jubilee scheme. So repayment schedule must match the crop cycle of the farmer. Government guaranteed advances. So there are central government guarantees and state government guarantees. In central government guarantees, even if overdue, these are not classified as NPA unless the government refuses to honor the guarantee when invoked. But banks cannot recognize income unless interest is actually received. And for state government guarantees, if overdue for more than 90 days, they must be treated as non-performing assets. Projects under implementation. So when banks finance large projects, repayment depends on the date of commencement of commercial operations. And RBI has laid down detailed norms for handling delays and changes. So if there's a deferment of date of commencement of commercial organization, then the banks can allow extra time without downgrading the loan within the limits. If there is a change in ownership, if the project changes hands within allowed timelines, bank can still treat it as standard. If it is deemed DCCO, if a project has multiple units and some starts working, those can be treated as operational for classification. For cost overrun, extra loans for cost overruns follow specific asset classification norms. Um, Income recognition. So the project loan is standard. Bank can recognize income on accrual basis. And if it is substandard, income is recognized only on actual receipts, meaning to say cash basis only. If debt interest is converted into instruments like bonds, equity, then those follow restructuring norms. Post shipment supply credit. So this refers to credit given to exporters after they ship goods abroad. For countries where ECGC cover is available, ECGC is Export Credit Guarantee Corporation. So if ECGC cover is available, Exim Bank provides a guarantee come refinance scheme. If the exporter defaults, Exim Bank pays the bank within 30 days of invoking the guarantee. To the extent Exim Bank pays, that part of loan is not treated as non-performing asset. Export project finance. So sometimes bank finance large export projects where an Indian company export goods or services to another country. Now the importer may pay the full dues to the bank in their own country, but due to political reasons, the money cannot be remitted to India. In such cases, the lending bank is not at fault and neither is the importer. If the bank can show documents providing that the importer paid on time, then the loan will not immediately be classified as a non-performing asset. Instead, the bank is allowed to wait 1 year from the date of deposit. Transfer of loan exposure. So sometimes one bank transfers its loan exposure to another bank or financial institution. And for such transfers, the rules of asset classification and provisioning are as per RBI Transfer of Loan Exposure Directions 2021. This means that whichever bank currently holds the loan must follow the RBI guidelines for recognizing NPAs and setting aside the provisions. Credit card accounts. So, a credit card account become NPA if the minimum amount due is not paid fully within 90 days from the payment due date. If payment is missed, the account is reported as past due to Credit Information Company (CICs). However, banks can charge late payment fees or report the account as past due only if it remains unpaid for more than 3 days after the due date. Upgradation of restructure accounts. So sometimes when borrowers faces difficulty in repayment, bank restructures the loan, changes repayment term like extend, tenure, reduce installment, etc. And a restructure account is considered substandard initially. It can be upgraded to standard only after 1 year from the date uh, when the first payment becomes due under the new schedule, provided the borrower makes timely payment during the year. If performance is not satisfactory, then the account classification is done as per earlier norms, and provisions made earlier can be reversed if repayment is satisfactory after 1 year. Takeout finance. Takeout finance is mainly used in long-term infrastructure projects. Here, one bank finances the project initially but later transfers the loan to another bank or financial institution. That institution is known as takeover institution as per the agreement. Between financing and takeover, there may be delays and defaults by the borrower is possible. So, the bank which currently has the loan in its book must classify it based on the repayment record, and if the borrower defaults before takeover, the loan must be marked as NPA by the lending bank. The takeover bank, once it acquires the loan, must also treat it as NPA from the actual date of default, even if the loan was not yet in the books. General norms for provisioning. So now let's understand the provisioning norms. So basically, there's a risk that the borrower will not repay, and if repayment not happens, the asset becomes non-performing assets. To deal with such situation, RBI has laid down provisioning norms. These are the rules for banks to set aside a certain percentage of money against different categories of assets. If it is a loss asset, then a loss asset is one where recovery is considered impossible. So banks are required to write off such assets, and if they are retained in their books for any reason, they must give 100% provision. Doubtful assets alone become doubtful if it remains in the substandard category for 12 months, right? The provisioning depends on whether there is a secured portion or not. If it is unsecured, so for unsecured provision portion, 100% provision must be made. meaning to say there is no realizable security. And if there is a secured portion, provisions vary depending on how the assets had remained doubtful. For up to 1 year, 25% of provision is required. For 1 to 3 years, 40% of provision is required. And for more than 3 years, 100% of provision is required. For large non-performing assets, bank must conduct annual stock audits by an external agency to verify the security value, or get immovable properties revalued once in 3 years. Substandard assets. So there's a general provision of 15% of the outstanding amount. Unsecured substandard assets. For unsecured substandard assets, there's addition of 10% provision. So you make extra 10% provision, making it 25%. For infrastructure project loans with escrow arrangements, are to be made at 20% instead of 25%. Now, let's understand unsecured exposure. So, these are the cases where the bank has little or no tangible security to fall back upon. For unsecured doubtful assets, you make 100% provision. An exposure is treated as unsecured if the realizable value of security is less than 10% of the outstanding amount. Now, licenses, rights, or permissions, they cannot be treated as tangible security. So, loans covered only by such rights, they will be considered unsecured. In infrastructure projects, like road projects, where there are annuity receivables or toll rights, they may be treated as tangible asset if they are legally enforceable. And bank must disclose separately the amount of loan which are backed by intangible assets. Standard assets. So standard asset is a performing asset where there are no defaults. Even though these loans are safe, RBI requires bank to make a general provision as a precaution. Now the rate depends on the type of loan. If it is a farm credit, housing loan, loan to small and medium enterprises, then a provision of 0.25% is required to be made. If loans are provided to commercial real estate, then 1%. For commercial real estate residential housing, it is 0.75%. For housing loans at teaser rates are low initial rates which becomes higher at the later duration of time. Then 2% is required, and this reduces 0.4% 1 year after reset if the account remains standard. For restructured loans under natural calamity reliefs, the provision required is 5%, and for all other standard loans including medium enterprises, it is 0.4%. Now these provisions on standard assets are not deducted from gross advances while calculating NPAs. They are only shown separately as a safety buffer. Unhedged foreign currency exposure. So sometimes borrower have loans or commitments in foreign currency without proper hedging. If the currency fluctuates sharply, repayment capacity may be badly affected. To cover this risk, banks must make extra provisions depending on the borrower's riskiness. So the likely loss is up to 15%. There is no extra provision required. If it is 15 to 30%, then 0.2% of the exposure is required, or 20 basis point. For 30 to 50, 40 basis point or 0.4, 50 to 75, 60 basis point or 0.6, and 75% basis point 0.8% of the exposure is extra required as provision. Here EBID is equals to a profit after tax plus depreciation plus interest plus lease rentals. So it shows borrower's ability to service debt. Creation and utilization of floating provisions. So every bank must have a board approved policy for creating floating provisions. These floating provisions are created separately for advances, loans given to customers, and investments. So investments are money invested in securities or bonds. Unutilized floating provisions. So these are the floating provisions as special reserves. They cannot be used freely. Their usage is controlled by RBI. and the bank's board. So there are certain cases where it is allowed to use these floating provisions. So when you are getting approval from bank board, they are allowed only under extraordinary circumstances first, and only after getting approval from the bank's board and taking prior permission from RBI. So extraordinary circumstances means situations that are unexpected, exceptional, and not recurring in the normal course of business. These fall into three categories: general events like civil unrest, collapse of country's currency; market events such as complete financial market meltdown that affects all banks; or credit events only for very unusual and several credit loss. The floating provisions cannot be reversed to P&L account. They can only be used for making specific provisions in extraordinary situations. For reporting, they can either be netted off against gross NPS or be counted as part of Tier 2 capital, but limit of 1.25% of risk weighted assets is maintained. And banks must also provide full disclosure about floating provisions in notes on account or notes to accounts um, of their balance sheet. Additional provisions. So apart from regulatory minimum provisions, bank may voluntarily make extra provisions at higher rates. Now these are different from floating provisions. For NPAs, bank may set aside more than minimum required provision if they do it consistently year after year. For standard assets, bank can also create higher provisions for stressed sectors like real estate sector, power sector, even if those loans are still standard. Provision on leased assets. So when banks give out loan through leasing arrangement, they must also make specific provisions depending on the quality of those assets. Now, if there are substandard assets, so these are lease assets that have just turned problematic, but not yet doubtful or loss asset. Now, for provision, 15% for secured, and for unsecured, 25% extra 10% is required. It is same as before. And for doubtful assets also, it is same what we have discussed earlier. 100% for unsecured. For secured, it is classified into three categories: up to 1 year 25%, 1 to 3 year 40%, and for 3 years it is 100%. For loss assets, 100% of the provision is required. Provisions under special circumstances: advance against deposits or instrument. So if a borrower takes a loan against their own deposits like a fixed deposit, uh, KVPs, NSCs, the bank still needs to make provisions. The provision depend on how the loan is classified, whether it is standard, substandard, doubtful, or loss. Interest suspense account. So when interest is overdue, instead of adding it to income, banks put it in an interest suspense account. This account cannot be treated as part of provision, and first it should be deducted from the outstanding loan balance. After that, the banks make provision on the reduced balances. Advance covered by ECGC guarantee, Export Credit Guarantee Corporation. So ECGC provides insurance cover to banks on export loans. If such a loan become doubtful, the bank make provision only on the amount not guaranteed by ECGC. Before provisioning, the bank should deduct the realizable value of securities. Advances covered under CGT MSC or CRG FT guarantees. So these are schemes for micro and small enterprises and low income housing. If such loans become NPA, banks do not make provision on the guaranteed portion. Provisions are required only on the amount which is beyond the guaranteed portion. Reserve for exchange rate fluctuation account RERFA. When loans are given in foreign currency or linked to foreign exchange currency, depreciation can increase the loan outstanding. So banks should not normally revalue such loans. If revaluation is required, any loss must be charged to P&L account. and if there is a gain due to revaluation, it must be fully transferred to provision for that asset. Country risk provisions. So if bank lend money abroad, they face country risk of default due to political or economic condition in that country, and the provisioning depends on ECGC risk rating of that company. So if the risk is insignificant, then the provision requires 0.5. Again, low is 0.5. For moderate, it is 5%. If it is high, 20, very high, 25, restricted or off credit to 100%. So it ranges from 0.25% to 100%, and it depends on the risk category risk rating, which is done by ECGC. This is an addition to the provision based on asset classification. Foreign branches of Indian banks must include their host country's exposure, and lower provisions may be used for short term exposure where the exposure is less than 180 days. Liquidity facility for securitization transaction. If a bank provides liquidity support for securitization deals and the amount is outstanding for more than 90 days, then it should be fully provided for. Derivative exposure. Credit exposure from derivative transactions like interest rate swap, credit default swaps, gold contracts, they also attract provisions. And the provision should be same as for the standard asset of the counterparty. Housing loan at teaser rate. So some bank gives housing loan at teaser rate, meaning to say they charge very low rate of interest initially, but with time the interest rate increases. So the risk is the borrower may struggle to pay once the higher rates kick in, and to cover this serious risk, provisioning on standard assets under such loan is 2% initially. After 1 year of reset, if the loan amount remains standard, provisioning reduces to 0.4%. Large borrowers. So, as per RBI guideline, for very large borrowers, if the banking system's total exposure to the borrower exceed the normally permitted lending limit, banks must make additional provision of 3% on incremental exposure. Provisioning coverage ratio. So, provisioning coverage ratio is the ratio of provisions made by the bank to gross NPAs. In simple words, it shows how much of the bad loans are covered by the bank's provision. But there are certain guidelines for the banks. Like banks were told to maintain a PCR of at least 70%. If provisions are more than required, the extra amount should be kept in a special account called counter-cyclic provisioning buffer. This buffer can be used during an economic-wide downturn, but only with RBI's prior approval. If bank must disclose its PCR in the notes to account of the balance sheet so that stakeholders know how safe the bank is against the loan losses. Writing of NPAs. So according to Income Tax Act 1961, interest income from NPA it is taxable, but it is taxable only when it is actually received or credited to the P&L, whichever is earlier. The provisions made by non-performing assets, they are not tax deductible. This means bank cannot reduce their taxable income just because they made provisions. However, if banks write off the loans, they can claim tax benefits as per the rules, and recoveries made later from written off accounts must be shown as income and taxed accordingly. So banks can decide to write off loans centrally at the head office even if those loans still appear in the branch book. And before doing so, bank must ensure that the provisions are made as per RBI's assets classification rules. Banks must try all possible recovery methods before fully or partially writing to of an account, and full details of all write-offs, including technical write-off, uh, must be disclosed in the annual financial statement. Non performing asset management, effective mechanism, and granular data. Now let's understand why NPA management is important. The quality of a bank's loan reflects its financial strength and health. Now, high NPA means weak financial health. So, effective management it is very critical. Uh, what banks must do is that they should put in place a strong MIS system uh, to detect early morning signals of financial stress at individual level or at segment level. They should be able to detect early warning signals. So, at individual level, for example, one borrower showing repayment issues, or at segment level, there is a problem in an industry or geographic region. To use these warning signals to create a preventive asset quality management system. This includes transparent restructuring, and the aim is to preserve the economic value of the borrower and the business. We should also ensure reporting consistency. So, reporting consistency should be maintained. Information submitted to the regulatory or statutory authorities, they should match with the bank's internal MIS report. There should be no inconsistency between these two. And banks must maintain a detailed system generated data on NPAs and restructured assets, including opening balances, if there is any new addition in the NPA, if there is a reductions, closing balances, provisions, and technical write-off. Framework for resolution of stressed asset. So, there should be an early identification and reporting of stress. So, banks must identify signs of trouble in a loan account as early as possible. For this purpose, RBI has introduced special mention accounts, SMAs. So, if a borrower misses repayment of principal, interest, or any other due, the account is classified into one of these: SMA 0, SMA 1, or SMA 2. If the payment overdue is 1 to 30 days, 31 to 60 days, and 61 to 90 days, and accordingly, special mention accounts are provided. For revolving credit facilities, there is no SMA 0. So there is SMA 1 if the outstanding continuously exceeds the limit or drawing power for 31 to 60 days, or if the excess balance, if this continues for 61 to 90 days, then it is classified as special mention account 2. Account that crosses 90 days, if they cross 90 days, they becomes non-performing assets. With respect to reporting, so the bank must report all such SMA accounts to CRILC, mean to say Central Repository of Information on Large Credit. Now, this reporting is mandatory if the borrower has an exposure of 5 CR or more. And these reports must be sent monthly, and a weekly report must be sent for fresh defaults. Implementation of resolution plans. So once stress is identified, bank need to act quickly. The rules apply to scheduled commercial banks except RRBs. All India term lending institutions like NABARD, National Housing Bank, Exim, SEDB, Small Finance Bank, and large NBFCs. Steps involved is that you generally review, and review period is of 30 days. So once a default occurs, lender have 30 days to review the borrower's situation, and during this time they decide whether to restructure, regularize, sell the loan, change ownership, or start insolvency proceedings. Then there is a intercreditor agreement. So if restructuring is chosen, all lenders of that borrower they must sign an intercreditor agreement, and any decision approved by 75% of lender by value or 60% by number will be binding on all the members, all the lenders. Timeline of resolution. So once the review period ends, bank must implement uh, the resolution plan within 180 days. The review period starts either from the default date or the RBI specific reference rate. So reference date for exposure greater than 2000 crore is June 7, 2019. For 1500 to 2000 crore, it is January 1st, 2020. And for exposures which are less than 1500, the dates are yet to be notified. There are some types of resolution plans like regularization, sale of loan to another investor, change in ownership, or restructuring of loan terms. There are certain implementation conditions. So, if the exposure is 100 CR or above, any restructuring or ownership change needs an independent credit evaluation by authorized credit rating agency. All conditions prescribed by RBI, they must be met. If restructuring, the restructured terms or conditions are complied with, or if recovery or there is sale, then the bank's exposure is fully extinguished. Delayed implementation. So, if banks fail to implement a viable resolution plan within timelines, they must make additional provisions. If it is not implemented within 180 days, then there is an additional provision of 20%, and after 365 days, there is an additional provision of 15%, meaning to say total 35%. This ensures bank don't delay actions and take the problem seriously. Now let's understand some other aspects with respect to this framework. So prudential norms are there. So RBI's norm on restructuring or ownership change must be followed, whether done under IBC or outside it. If banks try to hide bad loans or keep evergreen stressed loans, then the RBI will take strict action. Bank must disclose details of resolution plans in their financial statements, and there are certain exemptions. So these rules do not apply to MSME covered by separate guidelines for revival and rehabilitation, and borrowers where RBI has already directed banks to start insolvency under IBC. Prudential norms applicable to restructuring. So first of all, we need to understand what is restructuring. So restructuring is a process in which a bank or lender gives a special concession to a borrower who is in financial difficulty. The main purpose is to help the borrower survive financially and at the same time ensure that the bank has a chance to recover money. Now, this may involve you change the repayment term, you roll over existing credit facility, so giving the borrower more time to use the current loan accounts, or provide additional funds, or you settle with extended time. So you agree to accept a lower amount or a structured payment where the payment period is more than 3 months. Now, banks must have a clear board approved policy for this on when and how restructuring can be done. This policy should define the warning signals of financial difficulty. Both qualitative and quantitative parameters are to be considered. Now, what are the signs of financial difficulty? What are the indicators of financial difficulty? So, if there is a default in repayment, there is a likely default in future, uh, delisting of securities happens. So if the borrower's listed shares are being delisted due to financial weakness or regulatory non-compliance, so we call it that the securities are delisted. If there's a weak cash flow, the actual or projected earnings are insufficient to service the current loans. If the account is already in NP or if there's a poor credit rating, so these are some of the indicators of financial difficulty. Asset classification. So RBI has actually set specific rules to ensure restructuring is not misused. Number one is asset classification. When a loan is restructured, it is normally downgraded as an NPA substandard, even if it was standard before restructuring. Its classification will continue as per aging norms, how long it has remained overdue. There are certain conditions for upgrade. So special rules exist for upgrading restructured accounts back to standard. If it is MSME borrowers with a total exposure of 25 CR, they have separate slightly relaxed norms. And for other borrowers, the rules depend on loan size, asset classification at the time of restructuring. Provisioning norms. So, when a loan is restructured, the bank may set aside money to cover potential losses. If a restructuring plan is submitted under IBC, then the provisions already made are frozen for 6 months from submission of the RP. or up to 90 days after the adjudicating authority approves the plan, whichever comes earlier. If provisions are less than required, then the bank must increase them. If the adjudicating authority rejects the plan, the freezing benefits ends immediately and normal provision norms apply. MSME restructuring has separate guidelines from the RBI. Additional finance, so sometimes bank provide additional finance during restructuring. So this additional finance is treated as a standard asset during the monitoring period as long as the borrower performs well. If the borrower again defaults, the additional finance will also be downgraded to the same category as a restructured debt. Similarly, interim finance under IBC is treated as a standard asset during the insolvency resolution process. Income recognition norms. So, when a borrower account has been restructured, the way banks record interest income depends on whether the account is standard or an NPA. If the account is standard, interest can be recorded on an accrual basis. So, even if it has not been actually received, it can be recorded. Now, if it is NPA, then it is recognized only when the bank actually receives it. For additional finance given to the borrower whose original loans were already NPA, so interest is recognized only on the cash basis unless ownership of the borrower company changes. Conversion of principal of interest. So during restructuring, part of the loan or unpaid interest may be converted into debt instruments, equity, or funded interest term loans, a loan created out of unpaid interest. These new instruments will be placed in the same asset category as the original loan. Change in ownership. So, if the ownership of a borrowing company changes, the company's loan can be treated as standard, but only if conditions prescribed by the RBI if they are followed. So, if the account fails during this period, it goes into a fresh review process, and bank can reverse provision only after the monitoring period ends and performance is satisfactory. Sale and leaseback transactions. So, if a borrower sells an asset to another party and then leases it back, this will be treated as restructuring if certain conditions are met, like the seller. The original borrower is in financial difficulty. More than 50% of the buyer's revenue from that asset depend on the payment from the seller. And thirdly, at least 25% of the buyer's loan for purchasing that assets come from the lender who already had exposure to the seller. Refinancing norms. So if borrower takes a new loan to repay or refinance an old loan, it will be treated as restructuring if the borrower is in financial difficulty. This applies when the refinance loan is taken from lender in the Indian banking system or with the support of Indian bank like guarantee, letter of credit, comfort letter, etc. Takeout finance means again long-term project loans initially funded by one bank but later transferred to other bank as per the prior agreement. These transactions are governed separately under RBI's detailed guidelines on income recognition, asset classification, provisioning, and capital adequacy ratio. Regulatory assumptions. So, when debt is converted into non SLR, uh, the usual restriction on banks' exposure to such securities it does not apply. When the debt is converted into the equity shares during restructuring, it is exempt from regulatory limits on capital market exposure, para banking investments, or interest group exposures. If we are restructuring fraud or willful defaults, let's understand SEBI regulations as well first. So, under certain condition, exemption from SEBI's ICDR, issue of capital and disclosure requirement, they are allowed. And for issuing equity during restructuring the price of shares, it will be determined as per a specified formula or methodology rather than the usual pricing rules. Now, let's move forward to fraud or willful defaulters. Normally, fraudulent or willful defaulters are not eligible for restructuring. However, if the existing promoters are replaced by the new ones and the company is completely separated from the old management, then only the bank may consider restructuring. And this is allowed without affecting any criminal proceeding against the old promoter or the management. Willful defaulter and non-cooperative borrowers. So, bank faces different kind of borrowers, different kind of defaulters, but there are two special categories that require strict action. So, willful defaulters and non-cooperative borrowers. Willful defaulters are borrowers who deliberately do not repay loans even though they have the capital to do so. Sometimes they divert funds for other purposes or even dispose of the secured assets without the bank's knowledge. And non-cooperative borrowers are the borrowers who refuses to share information with banks. They avoid meeting, they do not cooperate in the recovery process, and their behavior makes it difficult for the bank to resolve the problems. Now, provisioning for these willful defaulters are to be made. So, bank must maintain 5% provision for the standard accounts where the directors listed are willful defaulters. If it is a substandard asset, uh, and in case of secured loan for up to 6 months, the provisioning is 15%, and when it crosses 6 months, the provisioning increases from 15% to 25%. For unsecured loans, for unsecured loans, again, for if it is up to 6 months, 25%. If 6 to 12 months is there, then it goes on to 40%. You should not give any new facility to any willful defaulter if they are deliberately not cooperating. Then the bank can tag them as non-cooperative borrowers, giving notices, and this information is also reported to central repository on large credits. In any fresh loan to such borrowers, it will require higher provisioning by the banks. However, such new loans will still be treated as standard assets. Dissemination of income to ensure transparency and to prevent misuse of the banking system. Banks must submit details of willful defaulters where the loan amount exceeds 25 lakhs rupees to credit information companies within 1 month, and banks should report negligent auditors. So, if bank find that the company auditors have falsified accounts or failed in their duty, they must file a complaint with ICAI. Such complaints are also forwarded to RBI, IBA, and Ministry of Corporate Affairs. If law is wrongfully certified a property, uh, property's clear legal title, or if valuer inflate the security values, then IBA circulate these names among banks and central registry, so, so that the future assignments avoid these uh, professionals. Banks loan for financing promoters contribution. So promoter contribution means the money that promoter, the person who start or run a company, invest in equity capital in their own company. As per RBI's rule, promoters should use their own fund for this contribution. Banks are not normally allowed to give loans to promoter for buying shares or other companies, but again, exceptions are there. So, bank can lend money to specialized entities created only for the purpose of acquiring and reviving troubled companies. Such entities must follow RBI general guidelines. These entities should be financially strong and well capitalized, and their debt to equity ratio should not exceed 3 to 1. A specialized entity is a company, body, corporate, which is set up only for reviving these failing companies. And the promoter, it is promoted by individual institution or even government bodies. They are eligible to invest in same sector as troubled companies they are acquiring. Credit risk management. So bank faces risk whenever they lend money. RBI has given detailed guidelines on how banks should manage the credit risk. Some important practices include independent credit appraisal, stress testing, scenario analysis. So, independent credit appraisal is that bank must do their own assessment of the borrower and the project. With respect to testing, scenario analysis. So, especially for infrastructure project, bank should check how the project will perform if there are delays or cost overruns. You check promoter's equity source. So, bank must verify where the promoter's equity money is coming from. Sometimes company use borrowed money from the parent company and show it as equity, which hides the true financial risk. So, bank must ensure that the debt is not shown as equity in subsidiaries or special purpose vehicles. You have to verify the director. So each director has a unique uh, director identification number under the Companies Act, and bank must record this DIN and verify the director through independent sources. They should also check if any director are listed as defaulters or willful defaulters. Registration of transactions with CERSI. So CERSI is the central registry of securitization, asset reconstruction and security interest. So central registry of securitization assets, reconstruction and security interest, in short CERSI. Any loan that involves security interest must be registered with CERSI. If it's not registered, the bank cannot enforce its security right in case of defaults. Board oversight. So the board of directors of bank, they play a very important role in credit risk management. They should monitor asset quality. So the board must take proactive steps to stop the rise of bad loans and improve overall asset quality. They should use tools like central repository of information large credit. So bank must identify stressed accounts at an early stage, and the board must ensure proper classification of such borrowers. Review of these classifications should be done regularly, for example, every 6 months. Now, let's check your progress. When will a loan be non-performing asset? Interest or loan installment overdue for more than 90 days, correct. Account is out of order in case of overdraft or cash credit, correct. Bill remains overdue for more than 90 days in BP or BD, so all of the above is the correct answer. Direct advance to agriculture and SME under standard asset category requires the provision rate of, it requires provision rate of 0.25%. A substandard asset is one which has remained NPA for a period less than or equals to substandard, it is asking, so it is 12 months. Provisions required on an 8-month old substandard asset of a willful defaulter, it is 25%. Now let's do some practice questions. Question number 1. Consider the following statements regarding non-performing assets and related definition. Identify which of them are correct. So there is no need to read statement 1 because it is there in every option. So that's why it is correct. Statement number 2, cash credit or overdraft is stated out of order if account has no credit for, it should be 90 and not 60, right? So 2 is not correct. So C and D gets eliminated. 4 must be correct. It is there in both the options. So 3 and 5 remains. We can read either one of the statement and we'll get our answer. Let's read statement 3. A loan for a long duration crop becomes NPA. If principal of interest is overdue for, it should be 1 and not 2. Hence, this is not correct. So, statement 3 is not correct, making option B as the correct answer for this question. Consider the following statement regarding income recognition and NPAs. Identify which of them are not correct. So, income from NPA is recognized on accrual basis. No, it is not recognized on accrual basis, but only when it is actually received. So, this statement is not correct, making C and D uh, eliminated. C and D are not correct options. 2, 3 and 5 are common in both the statements. Only statement number 6 is required to be read. So, interest income on NPAs may be taken to income account even if recovery is made from fresh or additional credit facility. So, interest realized from NP is taken to income only if it is not sourced from fresh or additional credit facilities, and hence statement number 6 is not correct, making okay. So, it is asking for not correct statements. Let me erase this. So, 1 is not correct, and we have also read statement number 6, which is also not correct. So, all statements are correct. This cannot be a question. So, 1 is not correct, and hence option C is the correct answer for this question. Consider the following statement asking for correct statements. Net advances are calculated by deducting specific items like provision, suspense account, balance from gross advances. So, this statement is correct. 1 is correct. This gets eliminated. 2, floating provisions are excluded from net NPA computation only if used for tier 2 capital. So, floating provisions are deducted while calculating net NPA if they are not utilized towards tier 2 capital, and hence this statement is not correct. So, 2 gets eliminated. So, A is the correct answer for this question. Which of the following statements are correct with respect to classification treatment of NPA? Okay. So, let's read statement 1. A substandard asset is one which remains non-performing for a period not exceeding 12 months. So, this statement is correct. So, D gets eliminated. 3 is there in both. Let's read statement number 2. An asset becomes doubtful asset immediately upon being classified as substandard. No, it becomes doubtful only after remaining substandard for 12 months, and hence 2 is not correct, making option B invalid. So, 1 is there, 3 is there, 5 is there, 7 is there, 8 is there. So, 5, 7, 8, 5, 7, 8, 3 is also there. Only statement number 4 is different. So, let's read statement number 4. Advances against NSC and term deposits are not required to be classified as NPA even if overdue. So, they are exempted, but does not apply to all overdue advances, right? And hence, uh, this is not correct. That's why it makes option C as the correct answer for this question. So, because it does not apply to all overdue advances, that's why the statement is not correct. Consider the following statements regarding provisioning norms for advances. Identify which of them are correct. So, let's see statement 1. Loss account must be written off or provided for to the extent of 100% if retained in the books. So, this statement is correct. So, C gets eliminated. Statement number 2 is there in all the options, so there's no need to read statement number 2. Let's read statement number 3. For doubtful assets secured for more than 3 years, the provisioning required is 25%. No, it is 100%, not 25%. So 3 is not correct, so B is not correct. So 1, 2, 4, 5, 7 and 9. So 6 and 8. Let's read statement number 8. Advance restructured under RBI relief measure for natural calamities are provisioned at 5%. So, yes, they attract provisioning of 5%, and hence statement 8 is correct, making option A as the correct answer. Below are the statement relating to provisioning for country risk. Select the correct set of statements. Bank must make provision on net funded country exposure on a graded scale ranging from 0.25 to 100%. This is correct. The provisioning requirement for a country under moderate B1 is 5%. This is also correct. So 1 is correct, 2 is correct. Here 1 is not there. So 1 is correct, 2 is correct, 4, 5 is common. Let's see 77. The provisioning for a country under low A2 classification, the provisioning is 0.5. No, it is 0.25, not 0.5. Hence, A is not correct, making option D as the correct answer for this question. Which of the following statement regarding the write-off of NP and tax treatment are correct? Income by way of interest on bad and doubtful debts is chargeable to tax when it is credited to the bank's profit and loss account or received, whichever is earlier. So this statement is actually correct. So B gets eliminated. 3 is common in all the remaining options. 4 and 5 are different. So let's read option number 4. Banks are required to exhaust all available means of recovery before writing off any account, either fully or partly. This is also correct. So 4 is correct. Let's read statement number 2 as well. Amount set aside for provisioning of NP are eligible for tax deduction. So they are not eligible for tax deduction, and hence statement 2 is not correct, making option D as not correct. 4 is correct, which is only there in option A. So option A is the correct answer for this question. Which of the following statements are true regarding the framework for resolution of stress asset as per RBI guidelines? So lender must classify an asset as SMA immediately upon default. So this is true. Lender must classify asset as special mention account immediately on default. So 1 is correct. Even if we have not read statement of 1, 2 or 3, no harm would have caused to us. So this means 2 and 3 are also correct. Let's read step number 4. The intercreditor agreement requires approval from lenders representing 80% of the total outstanding value, 75% by number. So the ICA requires approval 75% of the total outstanding by value and 60% of lenders by number, and hence this statement is not correct. So statement 4 is not correct. If a resolution plan is not implemented within 365 days from the commencement of review period, an additional provision of 15% is required. This is correct. So 1 is correct, 2 is correct, 5 is correct. Hence option A is the correct answer for this question. Which of the following statement is or are true regarding the restructuring of loans? Restructuring involves the lenders granting concession to a borrower facing financial difficulty. This is correct. Restructured accounts are classified as standard assets immediately after restructuring. They are classified as substandard and not standards. So 2 is not correct, and hence we get our answer. Only option 1 and 4 are correct. Which of the following statements are correct regarding the treatment of willful defaulters and non cooperative borrowers? So the provisioning for standard assets of companies whose directors appear multiple times in the list of willful defaulters will be 5%. Even if it is standard, yes, the provision is 5%. So this is correct. So 2 gets eliminated. If an account is classified as NPA, accelerated provisioning applies based on asset classification period. So accelerated provisioning applies when the accounts become NPA based on asset classification, and hence this is correct. So statement number 2 is correct. So 1 and 2 are here together, and hence option C is the correct answer for this question. If you have any doubts, don't hesitate to ask us on our Telegram group channel JIBCIB Prep. Thank you for watching this session, and we'll meet again with unit number 29.